Exxon Mobil Corp, ticker symbol XOM, is currently trading at $112.71. Since the bottom of the last COVID crash, this stock is up almost 250% and also pays a very nice dividend yield of 3.37%. What we're going to be doing is looking at the stock, then taking it to my automated stock evaluation spreadsheet, looking at the company's financials and seeing if it's a buy or a sell using discounted free cash flow model, comparable company model, dividend discount model, and of course the Ben Graham formula for intrinsic value. So as I said, XOM, yes, it is doing very well since the bottom of the COVID crash, up almost 250%, but year to date, relatively flat, down 5% over the last year, and year to date up 10%. If we are to compare to the S&P 500 over that similar time period, the market will be beating it 19% to 10 and 26 to -4. But even if we look at here where the market is up 88%, this stock since the COVID crash, as I said, has been up 200%, beating the market over that time. So let's have a look at my automated stock valuation spreadsheet. If you're interested, check out my Patreon. And we put in the ticker XOM, and what this will do is it will load all the latest company financials so we can see if the stock is a buy or a sell. So currently market cap of 500 billion, PE of 13.5 with a market average of around about 29. This is looking good. Earnings per share $8.35, a beta of 0.9, meaning it is slightly less volatile than the market. And analysts do say it's a buy with $120 a share. Dividend 3.42%, which means it nets you around about $3.85, and it is a very safe dividend with 50% on the payout ratio and free cash flow payout ratio. If we look at Dividend Max, this will tell us when you should buy those shares if you want to receive the dividend, and ex-dividend date is the 13th of November, so buy before then. Now let's have a look at the revenues. Revenue is at $350, down from its prior highs of 2022, but trending in the right direction since 2020, which was the last crash. Net income, similar story again, $34.16 billion, trending upwards from the prior numbers when it was negative and going up, but obviously down from 2022. Free cash flow, similar story again, $32.4 billion. Shares outstanding, they are buying back shares, which means they're rewarding shareholders and also suggesting that their stock may be a little undervalued. So first we will look at the discounted free cash flow model. This is a way of valuing stocks, looking at their future free cash flows and discount them to today's value and then giving an estimate on that. So if we look at the averages, it actually puts it at around about a $35 stock, which does seem a little bit low. So let's see where we can improve this. So revenue growth rate, we are estimating around about 10% with 385 and 423 billion. Analysts are expecting probably slightly less numbers. Actually, you can see there you go. They're actually going to see decreasing revenues, yet they are expecting around about 5% growth per annum. So interesting to say that. Let's just say they'll keep it at this then. Net income margins, the net income margins should be a bit higher. Based on average of these, you can see it is around about 8%. Sorry, not 8%. That was the min, 10%. This will now put this to around about a $60 stock. And free cash flow, we're looking at usually around about 100%. So we'll go 95. And, oh wow, okay, that's massive. A $200 a share. So let's see if we can bring these down. Net income margins, I do still think that's about fair. They're expecting around about 5% based on analyst estimates, and this still puts it at $170 stock. So discounted free cash flow model says it is a buy. We'll now look at the dividend discount model. They do regularly increase their dividends apart from 2021. So we'll increase the expected growth, and with a discount price around about that, you can see it's currently about a $73 stock. If we look at the most recent numbers of 3.4 and 4%, we increase that and sort of assume that they're going to do that again, this would be about a buy at $132 a share. So if they continue to increase their dividend in line with their prior numbers, this would actually be a buy. as long as they keep on increasing the dividend. Now we'll have a look at the Ben Graham formula for intrinsic value. This was created by Ben Graham. Now, as we know, the analysts are expecting around about 5.2% in growth. So I'm going to say this is not a buy. Puts it about fairly valued. If they are able to increase at about 7%, then that would be a buy. And obviously, if as bond yields decrease, we've got to 4%, then this would be a buy. But its current state, not a buy. And finally, we look at the comparable company model. This is a way of valuing companies, looking at competitors in similar industries and similar sizes. So let me just go to Google on my other screen here. Exxon, comparable companies. I suppose immediately I'm thinking of is Chevron, which is ticker CVX. Another one is, I suppose, is British Petroleum. And Shell as another one. Look at SEL. So what this will do is it will load all the company's financial data for these other companies, and then we can compare them. If you are interested, check out my Patreon. So interesting, over the last year, you can see that Exxon, CVX, BP are down. Shell is up in that time. Revenue, Exxon is the highest with 350 billion. Growth rate positive over the last 5 years, which is not true for BP or Shell. Only Chevron is higher. EBITDA, highest 70 billion. Net income, most profitable with 32 billion compared to Chevron and Shell's 18. And profit margins does actually have the highest profit margins with 9.373%. Price to book, price to sales, it is actually one of the highest ones, highest in price to sales, and highest in price to book as well. PEG, which is Peter Lynch's formula for price to earnings growth. You want to see this closest to 1 and ideally lower. Second highest after BP, 5, 13, 2, and 2.3. EV to revenue, EV to EBITDA, and PE. All PEs, they're all pretty similar, which is quite interesting. EV to EBITDA is the highest. We do want lower numbers here. And based on all three of these, you can see it is actually not a buy with an average of $86 a share. If we were to just look at Exxon, you can see it puts it slightly more valued at $106 a share, but comparable companies currently says it is not a buy. So comparable companies model says it's not a buy. Dividend discount model says it's not a buy unless they keep on growing their dividend to rates that are 2024 and on the average of their last 5 years. Ben Graham says it's about fairly valued, and the discounted free cash flow model does say it is a buy, but normally discounted free cash flow models do like these sort of free cash flow generators where they have a lot of free cash flow on hand. Right guys, thanks for watching. Please give a like on the video if you enjoyed it, subscribe if you're not already, and I'll catch you guys next time.